What if the real economic crisis you fear has already happened? Not in the headlines, but in the silent architecture of a monetary system built to keep every nation, every institution, and every citizen permanently dependent. Think about it for a second. What if the greatest financial threat isn't a market crash, a recession, or a debt default, but a structure created long before you were born, designed so that no one can escape it? When you hear that governments are drowning in debt, when you see currencies weakening or economies struggling, you're not looking at failure. You're looking at the system functioning exactly as intended. And the people who built it knew that once the gears started turning, the entire world would eventually move to their rhythm. Across history, empires rose with armies and collapsed through overreach, but something far more subtle and far more powerful survived every downfall: monetary control. The blueprint behind it never needed borders, flags, or ideology. It needed only one thing: the ability to turn money into an instrument of obedience. Today, nations believe they shape their financial destiny. But the deeper you look, the more you notice a repeating pattern hiding beneath centuries of crises, reforms, booms, and collapses. A pattern constructed by a handful of architects who understood that the most effective form of power is the one the public never questions, because they don't even see it working. Understanding this pattern isn't just about economics. It's about history, geopolitics, and the mechanics of global influence. The same principles that reshaped entire continents in the past are still active today, embedded in the institutions we trust, the currencies we depend on, and the narratives we're told. And once you recognize the structure, every headline suddenly makes sense. Every crisis becomes predictable. Every political decision looks different. The question is not whether this system exists. The question is how deep it goes and how far its creators intended it to reach. You've probably felt the consequences without ever identifying the source. That quiet pressure, that sense that something is fundamentally off, that no matter how much money circulates, societies grow weaker, families struggle more, and nations keep sinking into obligations they can never repay. You ever felt that? You ever wondered why the world keeps moving in cycles that never truly resolve? Stay with this thought, because what you will see next may shift the way you understand global power. Before we move forward, let me know in the comments if you've ever sensed this hidden pattern in your own life or your country. Your insight matters here. And if this opening already sparked something in you, hit like and make sure you're subscribed so you don't miss what comes next. Now let's continue, because the deeper we go, the clearer the structure becomes, and the harder it is to ignore what lies beneath the surface. The deeper you examine the origins of the system, the clearer it becomes that monetary control didn't emerge by accident or from some spontaneous evolution of financial markets. It began with a handful of decisions made centuries ago, decisions that transformed money from a simple medium of exchange into a mechanism of influence that could outlast kings, governments, revolutions, and even empires. Long before digital currencies, central banks, or global institutions existed, the foundations were already being laid by people who understood something most of the world had not yet realized: that whoever controls the issuance of money controls the behavior of nations. They weren't thinking in election cycles or short-term policy wins. They were thinking in centuries, building a structure that would grow stronger as economies grew more complex, not weaker. When early governments discovered they could borrow against future taxes, a new form of power emerged. Instead of relying solely on armies or territorial expansion, they could now finance their ambitions through obligations that would bind generations. This shift was subtle, almost invisible, and that's exactly why it worked. The moment rulers learned they could borrow endlessly, the door opened to a model where debt was not a temporary burden, but a permanent tool. Money no longer represented value. It represented promises. And promises, unlike gold or land, could be stretched, manipulated, and multiplied without limit. This was the birth of financial leverage on a national scale, and it attracted the attention of those who recognized how such a system could be shaped to their advantage. Across Europe, the earliest architects of monetary influence realized something revolutionary. A government in debt is a government that can be steered. If a state needs constant refinancing, it must keep its creditors satisfied. And if its creditors become powerful enough, they cease to be partners and become the unseen governors of policy. Over time, the relationship reversed. Governments no longer commanded the financial world commanded them. What started as simple borrowing became dependency. What started as convenience became necessity. And the people orchestrating it understood exactly what they were building. They weren't interested in controlling land or armies. They wanted something far more durable, something untouched by the rise and fall of empires. They wanted control over the very lifeblood of economic existence. As this system expanded, the public never noticed the shift. To them, it looked like modernization. It looked like progress, more trade, more credit, more opportunity. But behind the scenes, the structure tightened. Every new crisis strengthened it. Every war accelerated it. Every financial innovation wrapped another layer of dependency around nations that believed they were becoming more powerful, when, in reality, they were becoming more entangled. And the irony is unavoidable. The more sophisticated the world became, the easier it was to bind it through money instead of force. This is the origin point, the moment where complexity became a weapon and debt became the most effective form of global influence ever created. And everything that followed took this blueprint and amplified it, shaping the world we live in today in ways most people still haven't recognized. As the system expanded beyond its origins, something far more consequential began to take shape. Debt, which once served as a temporary bridge in moments of national need, evolved into a permanent structure that governments could no longer function without. The moment states realized they could issue promises indefinitely, the architects of monetary power recognized the opportunity to turn those promises into instruments of control. Bonds became more than financial tools. They became leverage points. Nations didn't just borrow money. They borrowed stability, legitimacy, and influence from the very institutions underwriting their survival. What began as a mechanism to solve fiscal shortages turned into the backbone of global governance, a silent contract in which the creditor always held the upper hand. Over time, political leaders discovered that refinancing debt was far easier than enacting genuine reform. Instead of reshaping their economies or reducing dependence on foreign capital, they simply rolled their debt forward, pushing the cost onto future generations. This wasn't incompetence. It became a habit, a normalized behavior encouraged by the system itself. The deeper a government fell into the cycle, the more its options narrowed. Every new bond issued strengthened the hold of those who controlled the market. And every crisis, instead of prompting structural change, pushed nations further into the arms of creditors who offered solutions that always came with invisible strings attached. By the time global financial markets matured, the architecture was fully formed. Institutions with no democratic accountability gained the ability to pressure sovereign states more effectively than foreign armies ever could. A downgrade in credit rating could topple a government. A sudden withdrawal of capital could trigger recessions. A spike in interest rates could reshape domestic policy overnight. The real power no longer sat solely in parliaments or presidential offices. It existed in quiet boardrooms, in algorithmic trading systems, in the hands of those who could move billions with a keystroke. And governments played along because they had no alternative. They had already surrendered the mechanisms needed to resist. This dependency created a new geopolitical reality. Nations that believed they were acting independently were in fact reacting to incentives crafted by a system that transcended borders. Monetary policy wasn't merely domestic strategy, it was a global script. Fiscal decisions weren't national choices, they were responses to market expectations. Even military powers found themselves constrained not by rivals on the battlefield, but by bond markets capable of punishing any deviation from the established order. And through it all, the public saw only the surface: budgets, deficits, reforms, and political slogans. The deeper machinery, the real engine of control, stayed hidden behind technical language and economic complexity that few ever understood. By the time most governments realized how thoroughly they had been absorbed into the system, it was already impossible to break free. The promise of growth had become the chain, the institutions offering help had become the gatekeepers, and the debt that once empowered nations now defined the limits of their sovereignty, setting the stage for an even more expansive and coordinated global structure of monetary influence. As this system matured into a worldwide mechanism, something remarkable happened. What began as scattered financial innovations across different empires converged into a unified architecture that no single nation could escape. The architects of monetary control understood that influence grows exponentially when it becomes standardized. So they created rules, institutions, and frameworks that looked like cooperation but functioned as containment. Once countries entered this structure, they were absorbed into a network where their monetary decisions reverberated through a web far larger than themselves, binding them to a logic that overrode domestic interest in favor of global financial continuity. Central banks, once peripheral institutions focused on stabilizing currencies, turned into the operational core of this architecture. Their decisions affected not only the health of their own economies, but also the flow of capital worldwide. They coordinated interest rates, harmonized monetary policies, and reacted to crises with a uniformity that made independence largely symbolic. Behind the scenes, international lenders and financial consortiums shaped the limits of acceptable economic behavior. Nations that tried to deviate from the established order found markets turning against them almost instantly, reminding them that sovereignty was conditional upon compliance. As global markets integrated, the system became self-reinforcing. When one country took on debt, the institutions managing that debt connected it to dozens of others. When a major economy shifted its policy, capital flowed across borders in waves, dragging smaller nations with it. A crisis in one region triggered tremors in another. Suddenly, no economy existed in isolation. Every government was plugged into the same circuit, and any attempt to unplug risked immediate economic collapse. This interconnectedness was presented as progress, but it also ensured that the deeper a country participated in global finance, the more it relied on forces beyond its control. The structure grew so vast that even powerful nations found themselves subject to its momentum. And this is where the illusion of choice becomes most evident. Governments speak of autonomy, strategic planning, long-term development, but the constraints imposed by the monetary architecture shape every decision they make. Inflation targets, deficit ceilings, currency valuations, debt rollovers, these are not merely policy preferences. They are obligations, enforced by an ecosystem designed to keep the entire world aligned under one overarching financial logic. It is a system engineered to reward submission and punish deviation, ensuring that the original architects never lose influence, even as centuries pass and political landscapes shift. Most citizens never recognize this pattern because its brilliance lies in subtlety. It doesn't look like domination. It looks like stability. It looks like cooperation. But underneath every treaty, every bailout, every coordinated policy is the same internal structure that ensures the flow of power remains upward, away from nations, and toward the entities that built the system in the first place. If any part of this structure reminds you of something happening in your country today, share your thoughts in the comments. Your perspective might reveal patterns others have missed. The deeper nations integrated into this expanding structure, the more a subtle illusion took hold, one so convincing that even seasoned economists and political leaders continued to repeat it without questioning its foundations. It was the belief that countries still controlled their own economic destiny, that sovereignty over currency and policy remained intact, and that governments could steer their nations according to their own strategic vision. Yet beneath the surface, the reality was far different. The moment a country tied its monetary system to global flows of capital, it surrendered a portion of its autonomy to forces operating far outside its borders. The institutions managing those flows were not elected, not local, and not accountable to the public whose lives they impacted. Governments spoke confidently about growth targets, fiscal strategies, and development plans, but the parameters of those plans were always shaped by external expectations. Every budget had to be acceptable to the markets. Every rate decision had to reflect global sentiment. Every attempt at reform had to align with the priorities of creditors, who cared far more about repayment schedules and financial stability than about domestic well-being. Sovereignty, in practice, became a negotiation rather than a right. And as the system grew more complex, nations found that their choices narrowed with every passing decade. When a country tried to assert independence, whether through currency reforms, capital controls, or alternative financial alliances, it quickly encountered the invisible boundaries of the system. Money fled, ratings dropped, investment froze. The pressures were immediate and precise, forcing governments back into the alignment. This wasn't the loud, visible coercion of old empires. It was something quieter and far more effective. A feedback loop in which deviation triggered economic pain and compliance restored short-term calm. Nations were conditioned to obey not through threats, but through predictable consequences embedded in the architecture itself. This is why the narrative of economic sovereignty persists. It is comforting. It offers a sense of agency. It allows leaders to pretend that national destiny is shaped solely within their borders. But the truth is that sovereignty has been reframed, redefined, and ultimately minimized by a structure that governs from above, not through overt domination, but through dependency. The dependency on foreign capital, on global liquidity, on institutions that claim neutrality while enforcing alignment with principles that preserve the system's continuity. The public rarely sees this dynamic because it unfolds through policy language, through subtle market reactions, through institutional statements that appear technical rather than political. Yet every fluctuation, every fiscal adjustment, every shift in monetary direction reveals the same reality. The autonomy nations believe they possess is largely an illusion, maintained for stability while real power flows elsewhere. As this illusion persists, the next transformation in the global system grows closer, shaped not by elections or politicians, but by the same mechanisms that have been expanding quietly for centuries. As the system tightened its hold on nations, crises became more than just moments of disruption. They became catalysts that reinforced the architecture of monetary control. Every financial panic, every recession, every geopolitical shock created the perfect opening for the system to deepen its influence. When markets collapsed or currencies faltered, governments rushed not toward independence, but toward the very institutions that had shaped their dependency in the first place. They sought liquidity, guarantees, rescue packages, anything that could stabilize the immediate turmoil. and each intervention came with terms that quietly expanded the reach of the global monetary framework. Throughout history, moments of instability have often revealed the true centers of power. Crises expose weaknesses, but they also expose connections. When nations found themselves unable to manage their financial shocks alone, they turned to the network that had grown around them. Central banks coordinated emergency measures. International lenders stepped in with stabilization loans. Financial markets rewarded compliant behavior and punished hesitation. What appeared to be cooperation was actually consolidation. The more fragile the global economy became, the more indispensable the system grew, because it presented itself as the only structure capable of restoring order. This dynamic created a cycle in which crises served as accelerators rather than interruptions. When a nation experienced a currency collapse, new credit facilities tied it even more tightly to external oversight. When a banking system imploded, regulatory adjustments aligned it more closely with global standards. When public finances deteriorated, long-term reforms were imposed that permanently tethered the country to creditors who claimed neutrality but operated according to a logic that transcended national priorities. In this model, crisis wasn't an obstacle. It was an opportunity to reshape policy environments, strengthen institutional influence, and standardize economic behavior across borders. Even global superpowers, nations once confident in their independence, found themselves compelled to act within parameters shaped by this expanding architecture. Military strength couldn't shield them from the influence of financial markets. Political ideology couldn't override the incentives set by global liquidity flows. Every downturn revealed that power no longer resided solely in the hands of governments, but in the interconnected web of monetary mechanisms that defined what was possible, what was acceptable, and what was inevitable. The brilliance of this structure lies in its ability to grow stronger precisely when everything else becomes weaker. A crisis that devastates households, businesses, and national budgets simultaneously validates the need for greater coordination, deeper integration, and stricter compliance with the system's rules. Each event that appears chaotic, on the surface, ultimately reinforces the underlying design. Nations emerge from crises not more independent, but more aligned, more standardized, and more reliant on the system that presents itself as their only shield against collapse. And as this pattern repeats, the world moves steadily toward a stage where the line between sovereignty and submission becomes blurred, not through force or conquest, but through a steady tightening of financial dependency that reshapes the global order, one crisis at a time. As crises continued to shape the system, another layer of control emerged, one that connected money, debt, and geopolitical strategy so tightly that it became impossible to separate economic decisions from global power dynamics. Nations no longer interacted on the world stage purely through diplomacy or military alliances. Instead, their leverage was increasingly defined by the structure of their currency, the scale of their debt obligations, and the influence of the institutions that managed those flows. This silent alignment between monetary design and geopolitical ambition allowed certain players to exert pressure not through armies or treaties, but through the mechanics of financial dependency woven into the international landscape. When currencies became globally interconnected, they stopped being simple instruments of domestic policy and transformed into tools of influence that reached across borders. A country's ability to project power was no longer measured solely by the size of its military or its natural resources. It was measured by how central its currency was to global trade and how essential its debt was to the financial portfolios of other nations. A dominant currency didn't just facilitate commerce. It created obligations, dependencies, and vulnerabilities in every corner of the world that used it. Countries that relied on these currencies found that any disruption, intentional or not, sent shockwaves through their economies, revealing just how deep the system's influence truly ran. Debt amplified this dynamic even further. A nation deeply indebted to global markets had to shape its policies around the expectations of creditors, who often had interests extending far beyond economic stability. Geopolitical decisions became entangled with monetary consequences. Supporting or opposing certain international actions could affect capital flows, access to credit, or the stability of a country's currency. Foreign policy was no longer just a matter of national will. It was shaped by an underlying financial logic that rewarded compliance and discouraged deviation. Even powerful countries discovered that their geopolitical options narrowed when their financial systems were intertwined with global networks that responded instantly to any sign of divergence. Meanwhile, nations seeking influence learned to wield their own monetary systems as strategic instruments. By extending loans, offering development funding, or building trade partnerships anchored in their currency, they could gradually draw other countries into their sphere of influence without firing a single shot. The debt created obligations, and the obligations created alignment. This strategy reshaped global alliances, redrew power structures, and allowed rising powers to exert pressure through economic ties, rather than military force. The architecture of global finance became the architecture of geopolitics, with every loan, bond, and currency swap carrying implications far beyond economics. As these patterns multiplied, the world drifted into an era where geopolitical tension and monetary dependency became inseparable. Decisions that appeared political were often the result of underlying financial pressures. Conflicts that seemed ideological were influenced by the vulnerabilities created by debt and currency exposure. The system didn't just shape economies, it shaped the global order itself, guiding nations along paths they didn't choose, but had little power to resist. If you see these connections playing out in today's world or recognize parallels in current events, share your thoughts in the comments. Your perspective on these patterns might reveal insights others haven't noticed yet. As these geopolitical dynamics intensified, the weight of the system began to fall most heavily on individuals, families, and entire generations who had no influence over the decisions shaping their lives. While global institutions and powerful nations maneuvered within the monetary architecture, ordinary people experienced its consequences in the most intimate ways through rising costs of living, stagnant wages, unstable currencies, and cycles of economic pressure that seemed to tighten with every passing decade. The impact wasn't merely financial. It reshaped the expectations people had for their futures, subtly lowering the horizon of what felt possible, while normalizing burdens that previous generations would have found unthinkable. This is where the human cost of an inescapable monetary system becomes impossible to ignore. When nations accumulate debt, the burden rarely falls on the institutions that orchestrated the borrowing. It falls on citizens who must navigate higher taxes, reduced services, or inflated prices as governments struggle to stay afloat within the global structure. Families feel it when their savings lose value faster than they can accumulate them. Workers feel it when their wages fail to keep pace with the cost of housing, healthcare, and education. Young people feel it when they inherit economies that demand more effort for fewer rewards, while carrying obligations created long before they were born. Debt transforms from a macroeconomic concept into a generational constraint, a quiet force that shapes life choices without ever announcing its presence. It influences when people can afford to start families, whether they can buy homes, how long they must work before retiring, and how much of their income is consumed by interest payments embedded in everything from mortgages to national budgets. Even those who avoid personal debt cannot escape the indirect effects, because public debt infiltrates every layer of society. It dictates the resources available for schools, infrastructure, healthcare systems, and social programs. It determines how resilient a country can be during crises and how much opportunity remains accessible to its citizens. This pressure grows heavier during periods of inflation or currency instability, when the value of work shrinks while the cost of essentials rises. People experience this as stress, uncertainty, and a gradual erosion of confidence in the future. Yet these symptoms are not random. They are the result of a system designed to preserve global financial stability at the expense of individual stability. When nations are forced to adjust interest rates, devalue currencies, or impose austerity to satisfy external expectations, then way to die. Sacrifices are always paid by those least responsible for the structural decisions that created the vulnerability. And perhaps the most profound consequence is psychological. When people sense that no matter how hard they work, the economic ground beneath them keeps shifting, they begin to lose faith not just in institutions, but in the very idea of progress. They feel trapped in a cycle they didn't choose, one that shapes their lives as surely as any law or policy. This quiet erosion of hope is one of the system's most powerful effects, because it discourages resistance, encourages compliance, and ensures that the architecture remains unchallenged as it continues expanding across generations. As these pressures mounted across societies, a new phase of the system revealed itself, one that many people sense intuitively but struggle to articulate. It is the moment when historical patterns, long obscured by complexity and technical language, begin to surface in ways that cannot be dismissed as coincidence. Nations experience simultaneous inflationary waves, synchronized debt crises, coordinated monetary responses, and geopolitical tensions that appear disconnected on the surface but are deeply connected underneath. These signals are not random fluctuations. They are the symptoms of a global structure reaching a critical stage of its long evolution. In recent decades, technology has accelerated the visibility of these patterns. Information moves faster, capital moves. Instantly, an economic shock spread not in years, but in hours. What once took a generation to manifest can now unfold in a single market cycle. As a result, the underlying architecture of monetary control is more exposed than ever before. Central banks react in near unison during crises, adjusting rates as though following a script rather than responding to local conditions. International institutions deploy programs that mirror one another across continents. Even the language used to justify These interventions has become standardized, revealing how aligned the decision-making network has grown. At the same time, nations that once relied on the stability of dominant currencies are beginning to quietly diversify, seeking alternatives that shield them from the vulnerabilities embedded in the existing system. Moves toward regional trade agreements, new reserve assets, and alternative payment networks all reflect an awareness that reliance on a single monetary core creates risks that no country can ignore forever. Yet these attempts at diversification rarely break the deeper dependency. They often end up creating parallel structures that still operate within the overarching logic of global finance, reinforcing the same principles they attempt to escape. The tension between these emerging strategies and the established monetary order creates instability that ripples across markets. Currency volatility becomes more common. Debt service pressures intensify. Small disruptions in supply chains trigger widespread economic reactions. Nations try to adapt, but the more they adjust to the new landscape, the clearer it becomes that the system is approaching a point of transformation. The patterns that once moved through history at a slow, predictable rhythm now appear compressed, as though the entire structure is accelerating towards something that cannot be postponed indefinitely. And perhaps the most striking sign is the growing disconnect between public perception and institutional messaging. While official statements emphasize resilience, stability, and long-term planning, ordinary citizens feel the opposite in their daily lives. They experience rising costs, shrinking opportunities, and a sense that the economic environment is shifting beneath them. This divergence suggests that the system has entered a phase where its internal pressures are too great to mask with conventional narratives. What was once hidden behind layers of complexity now reveals itself through the lived experience of millions, indicating that the next stage of the pattern is already beginning to take shape. As the signals intensify and the structure shows clearer signs of strain, the final phase of this long cycle begins to reveal itself. Not through sudden collapse or dramatic announcements, but through a gradual tightening of the very mechanisms that once promised stability. Nations attempt to manage rising debt burdens, but each adjustment only exposes how dependent they have become on the architecture that binds them. Central banks push the limits of monetary intervention, stretching tools that once seemed limitless until their effects grow weaker with each iteration. Economic growth slows, not because of lack of effort, but because the system itself has absorbed so much leverage that every additional step forward requires greater sacrifice than the last. As these pressures converge, something fundamental starts to shift in the global order. The trust that underpinned decades of monetary cooperation begins to erode. Countries hedge against one another, forming new alliances, while quietly distancing themselves from the very institutions that once anchored their stability. Markets become more sensitive to political movements. Currencies fluctuate sharply in response to subtle policy shifts. What once appeared coordinated now feels fragmented, as though the system is struggling to maintain cohesion under the weight of its accumulated contradictions. This is the stage where patterns that have repeated throughout history start aligning with a speed that makes them impossible to ignore. And yet, even as these dynamics accelerate, the transition does not arrive with the clarity people expect. It unfolds quietly, almost imperceptibly, through a series of small adjustments, policy recalibrations, and market reactions that gradually redefine what nations can or cannot do. The shift is less like an explosion and more like a tide, steady, unrelenting, reshaping the landscape grain by grain. People continue living their lives, sensing something has changed but unable to pinpoint exactly when the shift began. Governments speak confidently about recovery, adjustment, reform. But beneath the messaging lies the same structure, approaching a point where it must either transform or force the world into a new configuration shaped by pressures no one can fully control. As the system nears this moment, every decision made by nations, institutions, and individuals becomes part of the larger trajectory. The consequences reach beyond economics, influencing politics, social stability, and even cultural expectations. History suggests that once a monetary order reaches this stage, it rarely returns to what it was. Instead, it evolves into a new form, one that may promise resilience, but inevitably carries forward the same logic of control refined through centuries of crises and recalibrations. And while no one can predict the exact shape this transition will take, the direction is becoming unmistakably clear to anyone paying attention. If you stayed with me until this point, it means this topic truly resonated with you. Let me know you reached the end by commenting the phrase, "I'm still with you," so I can see who is thinking deeply about this. And if this journey helped you understand the hidden structure shaping our world, consider subscribing so you don't miss what comes next. A like also helps this conversation reach others who need it. There's a video right beside this one that continues the reasoning from a different angle, so follow that path and keep exploring with me.